All right. Hello, grade 11s. I'm going to do this test with you. This test that you did on Friday, the 12th of April, which was, depending on when you watched this, it may be last Friday. It was the test on asset disposal. So I'm going to do it with you, and hopefully I don't make any mistakes. I do have the model answer to keep going back to. I wanted to, for some of them, write the answers in the blocks so you can kind of do it with me, and then I'll show you the model answer as well. So this first section I think is quite easy, so I don't know if we'll do it now. We may as well. Match the definitions in column A with the concepts in column B. Write only the letter of the choice of your answer. Assets are recorded in the books at their original cost. That is the historical cost principle. So 1.1.1 is E. The collective amount is written off against the asset's cost price over time. The collective amount of accumulated depreciation is written off over time. So 1.1.2 is D. 1.1.3, used to calculate the profit or loss on the sale of an asset. That will be asset disposal, F. Assets that are bought to generate income. That will be fixed assets. Oh, wait. I don't know. Fixed assets or current assets? I mean, fixed assets, we buy them in order to help us generate an income, such as trucks and so on. But current assets we buy sometimes to sell them. For example, some current assets are trading stock. We buy the trading stock and sell it to generate an income, so that one's a bit vague. But all fixed assets help us to generate income. Some fixed assets we don't buy and they do not really generate an income. For example, some current assets, for example, cash float is a current asset. We do not buy it and it does not help us really to generate an income. So I'm going to say this is B, fixed assets, and we'll double check that in a moment. The imputed expense is written off against the asset cost price every year. That will be depreciation, A. So if I've done it right, it's EDFBA. Let's check the model answer. EDFBA. Yes, that's right. So if you want to double check that, you can pause the video and internalize that information. Excuse me. 1.2. Fixed asset management, Jalalpur Clothing Limited. Okay, Jalalpur Clothing Limited. The following information relates to the fixed tangible assets of the financial year ended 28th of Feb 2024. Ledger accounts may be used. Required. List 3 points for good internal control over movable assets. This will be, you could use just logical answers here. Things like have someone who can oversee the sign out of the movable assets, security measures, that kind of thing. So let's take a look at some of these answers that you could have used. I'm not going to read them. I'm going to scroll to them, and if you want, you can pause the video and look at these possible answers. Are there more? Yeah, there's a couple more there. Okay, let's go back up. Then calculate the cost of land and buildings purchased on the 30th of November 2023. Let's take a look at our information. Here it is. Land and buildings went up from this amount to this amount. So if there was no other information, you would take the end of year amount and minus the beginning of year amount. Now let's see if there's any other information. Fast Builders provided an invoice on 30th November 2023 after completing a new storeroom. The full invoice amount was paid and debited to Land and Buildings. Repairs to the old storeroom, 275,000, were included in the invoice. This has not been corrected. The full invoice amount was paid and debited to Land and Buildings, but 275,000 worth was for repairs. So what we are seeing here is that we built a storeroom and repaired the old storeroom. The fees for both of those were put together in one invoice, but some of that should have been recorded as expenses, as repairs, which is an expense account, and some of it should have been recorded as Land and Buildings, an asset account. However, it says the full invoice amount was paid and debited to Land and Buildings, which means 275,000 of that amount should not have been debited to Land and Buildings. So we have increased the value of the Land and Buildings by 275,000 too much. Or as we could say, the Land and Buildings amount at the end of the year is 275,000 Rand overstated. So if we want to calculate how much we actually paid on the new storeroom, we would have to take the end of year amount, 4745000, minus the 275,000 that should not have been there because it's for repairs, 275,000, and then minus what we started the year with, 3350000. I'm not going to do that in my head, but let's see what it is in the model answer. There's the beginning minus the end, and then minus that extra 275 that shouldn't be there, and your answer is 1120000. Okay. Next, let's take a look. So we did 1.1.1, 1.1.2, 1.2.1.2.2, 1.2.3. Calculate depreciation on the vehicle for the year ended 28th of February 2024. So let's look at our information about, what was it? Vehicles, right? Yeah, vehicles. This is depreciation stuff. Land and Buildings, vehicles, there you go. The company has only one vehicle. The depreciation rate is 20% per annum on cost. It does not give us any other information about vehicles. Let's see what vehicle information we have in the trial balance. Well, it went from 750 at the beginning of the year to 750 at the end of the year. So there was no change, no increase or decrease in vehicles. So all we have to do is take our 750,000, multiply it by the percentage depreciation rate, 20%. So you can say 20%, or as I like to say, 0.2. That's the same as 20%. And that equals, that will be 150,000. So I'm just going to write here 150,000. And let's check our model answer if we got that right. Oh, right. Okay, so I would have lost marks here if the model answer was not lenient. So this was silly of me. I should have checked this. So we said 750,000 times 20% equals 150,000, which we marked correct. However, the actual answer is not 150,000. It is 89,999. And you will say, but how can that be? Because if you look at your current total accumulated depreciation on the asset, you will see that the accumulated depreciation is 660,000. So what's our current book value? Well, it would be 750,000 minus 660,000. That is to say, our current book value is 90,000 Rand. Now, you can only depreciate as much as you have book value. You cannot depreciate an asset below zero, right? So if you were to depreciate all of the remaining carrying value, you would depreciate 90,000. But in accounting, we do not depreciate to zero. We can depreciate down to 1 Rand, which means we take the maximum depreciable value that is remaining. See, we wanted to do 150,000, but that's too much. The maximum remaining depreciable value is 90,000. And so we take that 90,000 and we minus 1 Rand, because we have to keep 1 Rand on the books for the vehicle or the equipment or whatever it is. And what is 90,000 minus 1 Rand? It is 89,999 Rand. So whenever you do depreciation on an asset, it is important that you look at the remaining book value of that asset to make sure that you can depreciate it that amount. Otherwise, you will make a mistake like I made here, saying that depreciation was 150,000, when actually there isn't even 150,000's worth of depreciable value left on that asset. So always check how much depreciable value there still is. Here, we're still giving you the full marks. But in matric, and probably later in grade 11, we will not give the full 4 marks if you do not, if you say 150,000 instead of 89,999. All right, let's keep going. The next question says, where's the next question? 1.2.3 we've done. 1.3. Calculate the loss on the photocopy machine that was traded in on the 1st of December 2023. The business depreciates equipment at 20% per annum on the diminishing balance method. Diminishing balance means book value. Oh, my chair just lost its I don't know what you call it. It keeps depressing on its own. I think it's just old or something. On the 1st of December 2023, they decided to trade in a photocopy machine for a new model. So, let's calculate the loss that was traded in on the 1st of December 2023. If there is a loss, that means the figure will be on the credit side of the asset disposal account. If that is, I'm not sure yet if we're going to use that bit of information, but we might. So just know, if we use the T account, asset disposal T account, the loss would be on the credit side. All right. So let's keep going. Let's do that. Calculate the loss on the photocopy machine. Let's look at our information here. Our equipment went from 2 million to 2,250,000. That is to say, there was an increase in our equipment overall of 250,000. I'm going to put you at 250,000. That is the change in our equipment. But we traded in the equipment, our photocopy machine, which means there was a removal of some amount of photocopy machine and an addition of another amount of photocopy machine. Let's look at what other information is given to us. Equipment depreciation is 20% per annum on diminishing balance. The photocopy machine was traded in on the 1st of November 2020, on the 1st of December 2023 for 75,000 for a better model. a better model. I'm saying it like an American, for a better model. The fixed asset register reflected the following. Here is the one that we sold. It had a cost price of 180,000. Now we have to, in order to, wait, what are we calculating here? The loss on the photocopy machine. Okay. To calculate the loss, we need to take the cost price, that is historical cost, the cost price of the thing that we sold. Why am I doing those two dots? We don't need those two dots there. We have to, from the cost price, we have to minus the total depreciation right up to the day of disposal. So I'm going to say total depreciation. And then we have to minus whatever we got paid for it. In other words, in this case, it's trade-in value minus, I'm just going to write trade-in value. Trade-in value. So, the cost price was 180,000 Rand. The total depreciation was, well, first we had, from the day we, from the first year that we depreciated it 36,000. So we're going to minus that first year's depreciation. The next year there was depreciation of 28,800. So we're going to minus that depreciation. Remember that we are usually given the total accumulated depreciation up to the beginning of the financial year. But this time, for some reason, they've split the accumulated depreciation over the last 2 years. That doesn't matter. We just add it together. Now we have to minus the depreciation for this year, for the number of months that we've had it. So, how many months have we had it? We have had it, we sold it on the 1st of December. So, we have had it for the whole of March, April, May, June, July, August, September, October, November, December. No, not December. We have not had it for December. We sold it on the 1st of December. So we've had it for March, April, May, June, July, August, September, October, November. 9 months. We have had it for 9 months, not 10 months. So let's go here and say, and we have now considered that whatever depreciation calculation we apply, we will have to multiply it by 9 out of 12 months. Let's see what the depreciation is for this year. It's diminishing balance method, so we're going to take 180,000 that's the book cost price, minus accumulated depreciation, 36,000 plus 28,800, and now minus, and now multiply that, whatever that amount is, by 20%, because that's the depreciation rate, and by 9 out of 12 months, because we haven't had it for the whole year, only 9 months. Then whatever that is will be this last little bit of depreciation over here. That's what we're busy calculating. Now I have a calculator here on my book bag. Let's see. We're going to take 100 and no, we're going to first add together those two figures, 36,000. Hey, this damn chair irritates me. Plus 28,800, and that is 64,800. So 180,000 minus 64,800 is 105,200. We multiply that by 20%, and we multiply that by 9 out of 12 months. So let's see. Times 20% times 9 divided by 12. So the depreciation for this year, the current financial year, is 17,280. All right, now that we've got the final depreciation, so the last bit of depreciation, we can go ahead and include that in the total depreciation calculation we're currently doing. So what was that? Minus 17,280. If it helps you to understand what we're doing, what we can do is put in brackets the total depreciation, right? But now that it's in brackets, we have to make these plus like that. So we've got our cost price, 180,000, minus our total depreciation, which is these 2 years of accumulated depreciation plus this year's depreciation. Now that that would give us our book value. Now to know the loss, we have to minus the trade-in value. Well, the trade-in value, they said, was 75,000 Rand. There it is. So we take our this amount, this whole thing is our book value. We minus the amount we got for the thing, and let's see what our loss was. It'll be 180,000 minus 36,000 minus 28,800 minus 17,280, 97,920 minus 75,000 equals 22,920. If I have calculated correctly, the loss on the sale of this asset was 22,920. Or another way to say it is, we got paid 22,920 Rand less than what the asset was worth at this point. Okay. Let's see if I got that right. 22,920. Let's see. 22,920. There it is. See, there's our 180,000 cost price. Here's our accumulated depreciation. Here's the depreciation we calculated for the year. Here's the what we got paid for it. That is the trade-in value. And that gives us our loss. All right. Next, it says, for the next question, calculate the cost price of the new photocopy machine. Well, we know that our equipment went up in total 250,000. So, if we look at this final figure here, we know that this end of year figure includes the disposal of that asset. That is to say that we took 2 million. In fact, I'm going to write this for you somewhere. I'm going to do it in this little gap over here. We started the year with 2 million Rands worth of assets, of equipment. We disposed of 75,000, sorry. We disposed of, what was it worth? What did we buy it for? 180. We disposed of 180,000 Rands worth of equipment. Don't worry about the 75,000. That was the trade-in value. What we want to know is the historical cost. How much historical cost in our books was recorded for that disposed of asset? 180,000. So we took our starting amount. We disposed of some amount. We bought some new amount, and that equaled 2,250,000. Now you can just do some algebra. I'm going to take 2,250,000. Well, I'm going to first swap everything on either side of the brackets. All right? So we're going to put 2,250,000 on the other side. Now we need to take over these other figures to the other side. So when we take 2 million to the other side, that will be minus 2 million. Is that 2 million? Yeah. when we take minus 180,000 to the other side, that becomes plus 180,000. And that should equal that thing we're missing, which is the new stuff that we bought. So let's see. 2,250,000 minus 2 million plus 180,000 is 430,000. So I'm just going to write here 430,000. Let's see if we got that right. Let's go down to the model answer. Yep, 430,000. Done. All right, and then I think there's one more. Okay, grade 11s. I made a calculation error, and it took me on a tangent to figure out what I had done wrong. I had typed it into my calculator wrong, and so I'm just going to re-record the last question so that I don't take you on a long tangent trying to figure out what I'd done. So for this question, it says, where's the question? Calculate the depreciation on the remaining old equipment for the year ended 28th of Feb 2024. So we started this year with 2 million rands worth of equipment. So that is our old equipment. However, remember that we disposed of some of our old equipment. So when we want to calculate depreciation, we have to take out the bit of disposed stuff. Now remember, we have to take the disposed equipment out of the equipment figure, and the disposed accumulated depreciation out of the accumulated depreciation figure, because we're doing it on the diminishing balance method, which means we have to use book value. So we have to take accumulated depreciation off of the equipment amount. So let's start by calculating how much of the old equipment is there. We do not use the 2,250,000 figure because that includes that includes the stuff that we bought during the year, and we want to do it on the remaining old stuff. So we're going to say 2 million rand of equipment that we started the year with minus the 180,000 of disposed of equipment. That's the cost price stuff. Now we must minus the accumulated depreciation. We started this year with accumulated depreciation of 1,250,000, and we disposed of an amount, this amount here. You see I've circled it here. This was the amount of the accumulated depreciation up to the beginning of this financial period that belonged to the disposed of machine. If we add those two figures together, we will get 36,000 plus 28,800. We will get an amount of 64,800. 64,800 rand is the amount of accumulated depreciation that belongs to the disposed of equipment. So we're going to take that out of the accumulated depreciation that we're using to depreciate the other old equipment. So 64,800. So we take our 1,250,000 of accumulated depreciation, and we remove 64,800 of accumulated depreciation that belonged to this disposed of asset over here. And that should give us our book value of 634,800. if we now multiply this by our 20% depreciation rate, we should get the depreciation for the remaining old equipment for this year. And that is $126,960. I really hope I did not type something wrong into my calculator again. 126,960. Let's check. 126,960. Yeah, I got it. All right. So that is the end of the test. That's all the questions answered and explained. I hope it was helpful. And yeah, have a nice evening. Bye-bye.